Today we're diving into an analysis report. Don't miss the move. WULF Consolidating for a massive 2026 run.
Right?
And the core idea is that TeraWulf is shifting from a Bitcoin miner to an AI data center play. And that this pivot is what's going to drive it towards those, $26, $27 analyst targets.
It's a really powerful narrative. And the fundamental repositioning is, I think, very compelling.
But we need to make sure the analysis is resilient, that it can stand up to some serious counterarguments.
Exactly. And for me, that starts right away with the risk profile.
I had the same thought. The core thesis, this idea of a 3x to 15x multiple re-rating, is huge. It's exciting.
For sure.
But when you look at how the risks are framed, it just doesn't quite match the audacity of that bull thesis.
That's a perfect way to put it. So the assessment of risks, it focuses almost entirely on the existing exposure, which is Bitcoin's price.
Right, the old business model.
And it could really, really benefit from a much deeper analysis of the risks that come with this new AI data center pivot. If you're trying to convince institutional money that this is an AI story.
Then the risks have to reflect AI realities, not just crypto realities.
Exactly. And right now, the bear case is just extremely narrow. It's basically all about a big Bitcoin crash, specifically below $60,000.
Which, is a valid risk, but it just neglects all the critical execution risks that are inherent in this kind of transition.
That's the weakness. It completely skips over the challenge of moving into high-performance computing and actually achieving those high AI multiples.
So there's a risk here that the analysis makes the AI transition seem like a foregone conclusion, like it's simple, almost risk-free.
And it's not. If the thesis really depends on hitting a 15x multiple, then the primary risks have to be about the potential failure to execute that shift.
Okay, so the suggestion for improvement is pretty clear.
I think so.
Expand that bear case section. You have to address the operational, the competitive, and the contractual risks that are specific to this miner to AI shift.
That gives it the intellectual balance it needs.
So let's talk about some concrete examples. What does that look like in practice?
Well, first, operational delays. The analysis hangs everything on this new 200 to 250 megawatts of HPC capacity.
Right, that's the engine for the 2026 revenue ramp.
So you need a real discussion about the potential for delays. What about sourcing power transformers, supply chain bottlenecks for, high-end NVIDIA GPUs, permitting?
These are the real-world things that can push a 2026 revenue story into 2027, and that completely changes the valuation today.
Drastically. So that's one, operational risk. But what about competition?
That's a great point. Once the capacity is online, who are they actually competing with? The report rightly highlights their low-cost power, which is a huge advantage.
It is. But are they just competing with other miners trying to do the same thing? Or are they up against, the giant hyperscalers who are also building out massive AI capacity?
That's the real question.
And that's the missing piece. The analysis needs to address the risk of pricing pressure, or even just the challenge of competing with the behemoth for GPU access and for those high-margin client contracts.
Because achieving a 15x multiple isn't just about filling rack space. It's about filling it with long-term, high-quality, visible revenue.
Which brings us to the third risk, contractual. The analysis points to the joint venture with FluidStack, which is backed by Google.
Yeah, that's a huge proof point. It gives them that stable revenue visibility. It's foundational to the whole argument.
It is. So you have to analyze the risk scenario where that JV isn't expanded. Or maybe it's not renewed on the same terms.
What happens then?
That's what the report needs to explore. That contractual stability is what Wall Street needs to see to justify those higher multiples. The analysis has to show that the revenue visibility is robust.
So by adding those layers, operational, competitive, contractual, the whole thesis just becomes so much more bulletproof.
Absolutely. It moves from feeling a bit like a promotional piece to a deeply considered, institutional-grade investment thesis.
Okay, so once the risks are properly defined, the next thing you have to do is justify that massive price target.
Which brings us to our second point, the valuation bridge.
The report makes a great case for the repricing. Pure Bitcoin miners trade at 3 to 5 times revenue.
While AI data centers get 15 to 20 times.
And that multiple expansion is the engine of the entire thesis.
It's the single most important assumption in the whole document. But the argument relies, I think, a little too heavily on the potential for that re-rating.
Without really quantifying it.
Yes, it doesn't clearly break down how much of that $26 or $27 valuation is supported by existing AI contracts versus how much is based on future, speculative capacity.
So the jump in the multiple is just stated as an assumption, not really demonstrated. That's the weakness.
So to really support that massive valuation leap, the analysis needs to explicitly bridge the gap. It has to connect the dots between the new operational capacity and that resulting multiple expansion.
We need to see the math.
That's the suggestion. You have to introduce a segmented valuation approach. Otherwise, anyone reading this is just going to assume the author slapped a high-end AI multiple on the whole business.
Which isn't accurate because it's going to be a hybrid business for a while.
For sure. So, as a concrete example, you could model a scenario that breaks down the 2026 revenue into two distinct buckets.
Okay.
First, you have the Bitcoin mining revenue, which is stable but low multiple. And second, you have the high-growth HPC and AI hosting revenue.
And then you apply the appropriate multiples to each stream. This is crucial.
Exactly. You put a conservative, say, 3 to 5x multiple on the mining part.
And you save that aspirational 15 to 20x multiple only for the AI portion.
And then you show how that composite, that blended multiple, gets you to the $27 target. It shows sophistication. It shows the value is earned.
That makes so much sense. But there's another part of the valuation that needs to be clearer.
The dilution.
Yes, the December 9th, 2025 capital structure cleanup. The report mentions it.
Right, the mandatory conversion of preferred stock and warrants. It's a huge event.
It cleans up the balance sheet, which is great. But it fundamentally impacts the share count.
It really does. So the analysis has to explain that dilution impact. It needs to show how the expected earnings growth is strong enough to absorb all that new common stock and still hit the target valuation per share.
I think a lot of analyses miss this step. They calculate a big enterprise value, but they don't fully account for the share count expansion that's coming.
And if you don't do that, it just undermines the credibility of the final price tag, especially for a sophisticated audience.
You have to show that detailed reconciliation.
By addressing the share count mechanics right next to the revenue segmentation, the analysis shifts from just, speculation to a rigorous, defensible financial model.
That really grounds the target in reality. So once we've defined the risks and we've grounded the valuation, we need to think about how the report is actually structured.
That's a perfect transition, because the issue here is really about pacing and perception.
What do you mean by that?
Well, the technical analysis provides a really strong, urgent entry point, but its prominence, where it's placed in the structure, it potentially overshadows the crucial long-term fundamental story.
Right. So let's look at the structure. The weakness is that the report dedicates a whole early section, Section 2, to short-term technicals.
The high-tight flag, the resistance levels, the volume profile.
And that comes before it details the multi-year fundamental pillars in Section 3.
And that pacing is so critical. Think about a long-term institutional investor reading this. They're looking for a multi-year hold. They care about infrastructure assets and contracted cash flows.
Not necessarily a short-term chart pattern.
Exactly. By leading with the technicals, the analysis might be perceived as just an urgent, tactical trade about a breakout, not the durable, strategic thesis the title promises.
You risk turning away the very capital you need to actually get the stock to $27.
So the suggestion is pretty straightforward. Rebalance the narrative. You have to subordinate the short-term technicals to the fundamental drivers.
So the technical setup isn't the reason to invest.
No, it's the immediate opportunity to accumulate based on the deeper 2026 thesis. The fundamentals have to lead the story.
So practically, that means reordering the sections.
Yes. For example, you should prioritize Section 3, the massive 2026 run thesis, and put it right after the intro hook.
You establish the gravity of the miner to AI repricing and the revenue ramp as the primary, non-negotiable drivers right up front.
The power capacity, the AI clients, that's the forest. The technical signals are just a few trees.
Okay, so what do we do with the technicals then? Because they are useful for timing and entry.
They are. So you integrate them. You take the core indicators, the consolidation, the validation of that 1620 level, and you put them directly into the summary or the trade plan at the end.
So it's the tactical layer on top of the strategy.
Precisely. And I think the source of the urgency needs to be refined too.
You mean it's currently focused on the golden crossover?
Yeah, and the most compelling urgency doesn't come from a moving average crossover. It comes from structural changes.
So you refocus the urgency on that December 9th, 2025 capital structure cleanup.
Yes, because that event fundamentally simplifies the story for big money. It forces a structural reevaluation of the equity. Now that is a truly compelling, time-sensitive, fundamental driver.
That makes so much sense. It validates the report's real purpose, which is to demonstrate a durable, multi-year holding thesis. The technicals just help you with the timing.
And that adjustment just significantly elevates the quality and the sophistication of the entire analysis.
Okay, this has been incredibly actionable. Let's just recap the 3 main opportunities for the listener to implement.
First, deepen that risk analysis. Go beyond just Bitcoin's price. Get into the weeds on the execution, competitive, and contractual risks of actually becoming an AI data center player.
Second, quantify the valuation bridge. Use that segmented approach for the revenue multiples, differentiate between mining and HPC, to mathematically justify that composite $27 target. And don't forget to model the dilution from the 2025 capital structure change.
And finally, resequence the structure. Put the long-term fundamentals first, the power assets, the AI pivot, the 2026 revenue ramp. Move the short-term technicals to the end to support the timing of the trade.